So, when things in the economy start to get a little shaky, how do the world's biggest banks try to figure out what's coming next? They don't have a crystal ball. What they have is a really powerful toolkit, one that's designed to understand and, more importantly, prepare for risk. Let's dive in and see how it works. Here's the big question. How do you measure a risk you can't even see? Just imagine you're a bank with thousands, maybe millions of different loans and bonds. The financial health of every single one of those companies can change at any moment. So the real challenge, the billion-dollar question, is figuring out the total risk when all those individual pieces are connected. It's a massive puzzle, and today we're going to see exactly how they solve it. All right, so to crack this massive puzzle, you got to start small. So in our first section, we're going to zoom all the way in and focus on just a single bond and look at all of its possible futures. This is the simplest building block of risk in a bank's portfolio, and understanding this one piece is the key to everything else. Okay, the first big idea we need to wrap our heads around is something called credit migration. Think about it. A company's financial health isn't set in stone. It's always moving. Over a year, its credit rating can go up, that's an upgrade, or it can go down, which is a downgrade. And in the absolute worst-case scenario, it could default entirely. This constant movement is what risk managers are paid to track. So, how in the world do you track that movement with any certainty? Well, you use history. This table here is what's known as a transition matrix, and it's basically our probability roadmap. What's so cool about this is that it's built using decades of real-world historical data. It tells us the odds of a bond with a certain rating, let's say an A rating, moving to any other rating within 1 year. It's an incredibly powerful way to see the range of possible futures. Now, I know a table like that can look a little overwhelming, so let's just make it simple. We're going to zoom in and just focus on one row. We'll follow the potential journey of a single A-rated corporate bond. What does the next year likely hold for it? Let's find out. All right, with a 91.05% probability, the most likely outcome is, well, nothing. A year from now, our A-rated bond is probably still an A-rated bond. And that makes sense, right? For solid investments, stability is what you expect. It's the baseline. But of course, what about the risks? There's a 5.52% chance it gets downgraded to a lower rating, maybe a BBB. If that happens, the bond becomes less valuable. It's a small risk for sure, but one you absolutely cannot ignore. And then you've got the worst-case scenario, default. The chance is a tiny, tiny 0.06%. Seems like a rounding error, right? Who cares? Well, a bank holding billions of dollars in these bonds cares a whole lot, because even a tiny probability of a total loss on a huge investment is a potential catastrophe that has to be planned for. Okay, so that's the range of futures for one bond. But what happens when you've got thousands of them, and one company's bad luck can affect another's? That's when we get to section 2, and we see the incredible ripple effect of risk. And this right here is the crucial point. In the real world, risks are almost never isolated events. You have uncorrelated risk, which is like lightning. One strike happening over here doesn't make another one more likely to happen over there. But in finance, risks are usually correlated, and that's way more like dominoes. When one company in an industry starts to wobble, it can set off a massive chain reaction. And this chart? Man, it just shows the danger perfectly. As the financial health of different companies becomes more interconnected, more correlated, the chance of them defaulting together just skyrockets. This domino effect is exactly how a few isolated problems can spiral into a full-blown financial crisis. So how on earth does a bank manage this tangled, interconnected web of risk? Well, you don't guess. You simulate the future, thousands and thousands of times. And that brings us to section 3. To solve this massive problem, JP Morgan developed a tool called CreditMetrics that eventually became an industry standard. And honestly, the best way to think about it is like a flight simulator, but instead of a 747, you're test piloting a bank's entire loan portfolio. It's designed to stress test that portfolio against thousands of different possible economic futures. So here's how that simulator actually works. First, it takes every single bond and maps out all its possible future paths using that probability roadmap we saw earlier. Second, and this is the key part, it factors in that domino effect of correlation. Third, it runs thousands of what-if scenarios called Monte Carlo simulations to see how the entire portfolio holds up. And finally, after all those runs, it spits out the full range of potential gains and losses. So, we've run the simulation, we have our results, but what does it all actually mean? What do you do with all that information? In Section 4, we're going to talk about the price of protection and the very real-world impact of all these numbers. After all that incredible simulation, the whole thing boils down to one single powerful number: credit VaR, which stands for value at risk. It answers one critical question: what is the absolute most we can expect to lose over the next year with 99% confidence? It puts a precise dollar amount on a plausible worst-case scenario. And let me be clear, this is not just some theoretical number on a spreadsheet. No way. This number has immediate, real-world consequences. That credit VaR figure tells a bank exactly how much cold, hard cash it needs to set aside as a financial shock absorber, just in case that bad year actually happens. And that shock absorber, it has an official name: economic capital. This is the financial cushion a bank is literally required to hold by regulators and by its own risk models, specifically to soak up huge, unexpected losses. It's the buffer that's supposed to keep the bank, and by extension the whole economy, stable during a crisis. This chart really helps you visualize it. That big slice represents the expected, everyday outcome of the portfolio: business as usual. That medium slice shows those unexpected but still possible losses, and that's the zone that economic capital is designed to cover. And that tiny little sliver at the end? That's the 1% catastrophic black swan event that even this buffer might not be able to handle. So why should any of us care about this? Because this whole process forces banks to find their hidden risk hotspots. It makes them build a bigger financial cushion if they're taking on more of that domino effect risk. And at the end of the day, it's one of the key tools regulators use to keep our financial system stable and to tell the difference between a well-run, diversified bank and a reckless one. Ultimately, it all comes down to this really powerful idea. The goal isn't to perfectly predict the future, because you can't. The real goal is to build a system that's resilient enough to withstand it. It's about putting a number on uncertainty and then building the shock absorbers you need to navigate whatever the future throws at you.